Hi, welcome back. You're watching MF Corner, and joining me now is Prableen Bajpai of FinFix Research. And today we're going to talk about which is the best way to get some global exposure to your portfolios. Hi, Prableen. Good afternoon. Most often when investors want to talk about getting global exposure, the advice that's given is, look at an international fund. Allocate 10-20% to an international fund. But is that the best way? I mean, are there more ways to invest, or get exposure to global companies? And which of them would you rank higher?
Hi, Sumaira. Good afternoon. Very interesting conversation you had with Feroz earlier. And so coming to your question about, investing internationally. So anything outside of India is, international investing. And if we just look at the mutual fund route to investing abroad, it is a very, very broad segment because it's got different schemes which are formed on different structures. They've got different risk profiles. They've got, very varied expense ratios. So I'll just like to quickly touch upon, the different ways that we actually have to invest abroad. So the most popular category, which is also reported by AMFI, is investing in a fund of fund, which is wherein you have a fund which is collecting money in India, and then that money is going and investing its money in a master fund, a global fund which is abroad, let's say a US based fund. So that's the most popular category, which is about 6,700 crore category in India. So, Mira, within this, when a mutual fund investing is collecting money in India and going and allocating that money through these different funds abroad, you again have the option to take exposure to different themes. You have the option to take exposure to different countries, regions, specific countries. Two examples here I'd like to give. One, let's pick Edelweiss, the Greater China Fund. Now, that is a fund which is collecting money in India and investing its money through the JP Morgan Greater China Fund. Another example would be the DSP Mining Fund, which is investing through the DSP Global Mining Fund. So this is one way of investing wherein it's a feeder fund in India, which is putting money in a master fund. There is another way to go and invest abroad. That is through just the way, mutual funds collect money and invest domestically. They collect money and on their own, they create a portfolio for their investors. And some of these examples are, the actively managed funds would be the ICICI Prudential US Blue Chip Fund or the Nippon India Japan Fund. These funds are collecting money and then, on their own, they create a portfolio in these markets based on the listed companies there. And this was the active approach. And then there's another way wherein money is collected and then it is invested in a passive form wherein the fund house in India is only going and replicating an index. Let's say it's picking the S&P 500 or the NASDAQ 100. So that's the broader category when we talk about international funds.
Okay, so three categories basically, or three avenues for people to invest in. One is a fund of funds, which is you have an international fund in your portfolio, right? The other is the actively managed fund, like Prableen said, and of course the passive funds. So Prableen, out of these three, which is the best way for somebody to invest in? Do they really need a specific international fund in their portfolio, or like you said, an actively managed fund would do the role?
Okay, I'd like to touch upon another category, Sumaira, which we usually don't talk about when we are talking about international investing, and those are the regular mutual funds in India, which are investing 65% in India. So they are typically taxed as per equity taxation. But the 35%, up to 35%, they have the freedom to go and invest abroad. One of the popular funds from this category is the Parag Parekh long-term equity. Currently, it has about 30% in the US markets. It also has the Suzuki Then you have the Access Growth, which is a mid and large cap fund, which also has an allocation about 20 to 23% abroad. Then there are other funds. There are about 10 to 12 funds. The regular funds, which are domestic funds, but they are going and investing up to 35% in the global markets. And one of the new ones here, the new NFO which is coming, which is the DSP Value Fund, Sumaira, even that one, it has a mandate to go and invest up to 35% globally. And the investment vehicle that they are looking to use for the same is invest in shares of Warren Buffett's company, which is Berkshire Hathaway. So that ways you are actually investing in a global fund, in a portfolio of global stocks, through one stock that they're going to pick. So that's another way of investing.
So which is the one that you recommend?
Okay, so number one, Sumaira, here the question is that why should anybody invest abroad? And if they do, then which vehicle should they take? So any fund which is going and investing and having a portfolio of more than 65%, they cross that limit. So it is an international fund and it would be taxed as debt taxation. That is the broader for segmentation between these two categories. Now, if somebody is looking to take a dollar hedge, because any money which is invested outside is dollar denominated in a dollar denominated asset, you get a hedge against the depreciation of rupee. Second, you have companies abroad which you don't have the exposure in the Indian markets. So, of course, it's a good bet to go and invest. Which route to take? Why not trust a global manager for your fund? So I would say that if you're looking and investing in a pure international fund, look at the master fund where it's investing. I'll give you an example here. I spoke about the Edelweiss China Fund. Now, Sumaira, that was launched in India in 2014, but the fund in which it's investing, that has a pedigree of almost 2 decades. So you have to see that not just the mutual fund in India, but also the core fund through which it's investing. So if you want to take that route, the feeder the feeder fund route, that's a good route to invest abroad, because there you get the expertise of international money managers to route your money, in the US markets, or if they feel, then outside of US as well. And the second good way to invest abroad is simply pick an index fund, which is tracking a global index. So these two routes I would recommend if somebody wants to take a significant exposure abroad.
Okay, what's an ideal time frame, if you're looking to add this a global exposure to your portfolio, and how much should it be?
So, Sumaira, just like the Indian equities, if you're looking to invest abroad, the time horizon has to be 5 to 7 years. The good thing about investing abroad is that why are we trying to do it? Because we want not only just returns, but we are also trying to reduce the volatility in our portfolios, because mature markets, especially as the US, like the US, are less volatile. So you not only get equity oriented exposure, but at lesser volatility. And if somebody is looking to do that, they still should have an investment horizon of 5 to 7 years. And also, we've seen such an uptick in the money which is coming into the these categories. I mean, it's almost thrice of what it was, the AUM of the FOF category last October end. Because all these funds have actually given about 50% plus returns in the last 1 year. So at this stage, I think investors have to also have a reality check when they're investing. Time horizon needs to be reasonably long. Second, a staggered approach. And, you go with a fund which you understand. Don't go with, you exclude. Don't go into commodities. Don't go into other emerging markets. India is one of the best emerging markets. If you're looking to take exposure, stick to US with a time frame, US or other mature markets, and with a time frame which is reasonably at least 5 to 7 years.
Okay, so basically, not all international markets and therefore not all international funds are created equal. So you have to tread with caution and choose the approach that works best for you. Prableen, thanks very much for joining in. And these are, of course, suggestions from our experts, but do consult your portfolio or your investment manager before you make changes to your portfolio. Thanks very much for watching MF Corner. Do stay tuned. The news continues on CNBC TV 18.